Before I introduce the speakers, let me just do a bit of housekeeping. So everyone's on mute at the moment because so that's a smoother transmission. If you have any questions, what we do is we use Slido. So you have to open another window and go to slido.com. Join in as participants with Slido code 37300 37300. And that's where you put in your questions, which we'll address at the end of the presentation. That will be smoother, I think, so it gives time for the speakers to speak. For ASM members, please register. There's a QR code there. Please register your name. So that's more for CPD. For everyone, just just stay on tight. Okay, so today this webinar is about evaluating TAKAFUL as an investor, where Shuhada and Emma will be speaking about what TAKAFUL looks like compared to insurance. They'll introduce some operational models that's commonly used in Malaysia, and finally wrap up with challenges and opportunities of TAKAFUL as a business investment. Shuhada is a partner at Actuarial Partners Consulting. She qualified as a fellow of CAS, Casualty Actuarial Society over in the US. Her expertise is in insurance, general insurance, and of course, in TAKAFUL, reinsurance and re-TAKAFUL. She's done a number of feasibility studies on setup of TAKAFUL, so she's well versed on this subject. Emma is a principal at Actuarial Partners. She joined us in 2009. She's a graduate of LSE, London School of Economics in UK, and is currently pursuing her final paper with the IFOA. Her consulting experience is similar to Shuhada in that she also works in the general TAKAFUL space. Shuhada, are you ready to take this on? Good luck.
Thanks, Aiza, for the introduction. Assalamualaikum and good morning, everyone. I hope you can hear me well. So I'm going to try to share the screen first, just to make sure that everyone can see it. Okay, so the screen should be up. So as per the slides, Shuhada, me and Emma will be presenting, will be co-presenting on today's talk today. This is actually a series of, okay, I'm trying to move the slides. Oops. Oh, okay. So I hope you can see the slide. So this is a series of TAKAFUL webinars and IFRS 17 for the next couple of weeks. And the session today would be the first one. So as you can see from the slide in your PC or laptop, we have 1, 2, 3, 4, 5 in total as far as this webinar is concerned. And obviously the end or the heavier discussion of this particular webinars on IFRS 17, and we thought that before going into IFRS 17, the first webinar today, it would be good to provide an introduction on what TAKAFUL is all about, the various model, and in particular looking at it from an investor's perspective. So that is our focus for today, which is the first of these 5. So I'll be presenting with Emma, and let me see. Okay, it's not my. Okay, so we have 4 main big agenda today. We'll discuss about what is TAKAFUL all about. How is it differ from insurance and mutuals? Because we're aware that some of the participants today, they're not particularly familiar with what TAKAFUL is. So we're going to go through in quite detail of these 2 topics today, because later on when you saw the 5 series of webinars, so the next 4 one will straight away go into the technicality of it. So we won't be talking about what is TAKAFUL about. So that is the focus of this webinar. So the first 2 sections will be covered by Emma, and I'll cover the the third and the fourth one, where we talk about the business investment or the investor's perspective of it. And lastly, in terms of, what are the roles of an actuary within Takaful. I just want to add a disclaimer that, both Emma and I, we're actuaries, so we're more familiar in terms of the technical application of Takaful. We're not Sharia scholar. So I just want you to bear that in mind. So we'll be happy to answer question that talks about, the technical application of Takaful. But we're not in a position to be addressing the Sharia concern of it. So just want to highlight that. So with that, I'll pass to Emma.
Thank you. Okay. So good morning, everyone. Okay, jumping straight into the introduction to Takaful. Okay, so when did Takaful start? Okay, Takaful is clearly relatively young compared to conventional insurance, as we all know. It started in late 1970s in Sudan, and this was actually following the fatwa or the Islamic decree that was released by the Organization of Islamic Cooperation, OIC, that declared the conventional insurance as haram, which is basically not permissible in Islam. So following this, Sudan was the first to respond to the fatwa by OIC, and what they did was to basically just overhaul their whole insurance system in the country and make them all takaful. So that's how it started in Sudan, and then other countries followed suit. Like Malaysia, we started about in 1984, yeah, when Syarikat was first incorporated. Understanding a bit of Islam as a way of life. So there are actually three main branches of Islam. So the first one on the left is Aqidah, which relates to the faith or the belief of someone about the teachings of Islam. So like believing that Allah is the one and only God and all that. So it relates to your faith and belief. And then the other end is the akhlaq, which is got to do with your morality and your ethics, like your practice of virtue, your morality and your manners in Islamic philosophy, basically. Okay, and the middle section, which is the Sharia, we have a few more subsections underneath, but just to highlight that Sharia is, it relates to the practices of your daily activities. So things like economic activities or the way you carry out your worship, the activities, so anything to do with your family matters, anything to do with crime and punishment. So these all fall under the Sharia, which is the Sharia laws. Okay, so where Takaful lies, Takaful would be a commercial contract bound by the requirements of Mu'amalah, this one. So we have guidance provided by religious scholars on Takaful through the fatwas that they issue. And because, I guess the key point to this slide is that because Takaful actually pertains to the Islamic activity rather than the faith of the person, so basically anyone, including non-Muslims, could subscribe to Takaful. And we do see that in Malaysia, like especially in the life insurance. So there are a lot of non-Muslims taking up the family Takaful, which is the life version of Takaful in Malaysia. Okay, so to cover some of the fundamental concepts of Takaful, okay, the first would be about risk sharing. So in Takaful, the participants, whom are the people contributing or donating money into the pool, they are sharing the risk between all the other participants. So there is no risk transfer like there is in conventional insurance, where the participant or the insured is transferring the risk to the insurer. So in the case of Takaful, the risk remains within the participants, but is being shared among all other participants. So it's very similar to a cooperative or a mutual insurer concept for Takaful. Okay, so that's first one. And then the second one, under the risk sharing model, so basically the intention or the niat for all the participants is to basically help each other who participate in the fund. So should any of the events that's covered occur, then we are basically already from day one, we have accepted by entering into the Takaful contract, we have accepted to, you know, share and help to ease the burden of the other members who are facing the loss, financial loss. So under Takaful, under the risk sharing model, the participants' contributions, which is the premium that you pay. So we already said at day one that this is a contribution. We call it contribution because it's a donation that we are making into the fund. Okay, so these money between all the members are accumulated, and this will be used to compensate for any financial loss that happened to the member of the fund. And therefore, should there be any surplus or deficit in the pool, then that would belong to the participants. So it's ours lah. Okay. Okay, and then on a similar note, the Takaful company in this matter, in this case, they are only acting as an agent for the participants. So they do not underwrite the risk. They don't take up the underwriting risk for their own account. Okay, but instead for being the agent to the participants for handling the pool and the management of the claims and all that, they are compensated by us, the participants, via a fee. So that fee could be in the form of wakalah fee or in the form of a performance fee. So that would be different according to the model that is adopted by the operator. So we will see that a little bit later in the presentation. And last but not least, for Takaful, it's very crucial that the investments of the Takaful fund, they have got to be Sharia compliant. So this means there shouldn't be any investments that are based on interest, which is called riba in Islamic term, Arabic term, sorry. And then it should not be investing in companies involved in non-Sharia activities, like selling of liquor and all that. Okay. Okay. So before we go into the different models around the world that we are going to show later, maybe it's just a brief highlight as to why there could be differences in the Takaful model adopted around the world. Like, why not just one model, standard model for everyone, right? So there are various reasons to that, and I guess the main reason would probably be the regulatory or like the Sharia aspect, because we have several various school of thoughts, and the way fatwas are released by each country's Sharia scholars could be different depending on their interpretation of how they see things, and probably something that the suitability of the needs for the country itself is different. So because of that, we have various models being practiced around the world. Okay, so the first model has got to be the Sudan, as I mentioned before, because Sudan was the first one that actually responded to the fatwa released by OIC on insurance being haram. So for Sudan, we know that basically they just turn insurance operations into Takaful. So we can see from this model here is very similar to insurance, because basically from the participant, you contribute, which is in insurance term is the premium. So for Takaful, you contribute your money into a risk account, which is a common account where all other participants will be contributing into as well. And out of this account, the money will be used to pay out benefits to whoever the participants that are suffering the loss. And then the fund will be accumulating investment profits. Okay, and then after paying all the expenses and paying all the claims, you've got the underwriting surplus coming from the fund. So this surplus goes back fully to the participant under this model. Okay, but what about the operator? So the operator gets their money or their revenue from the share of the investment profit that is generated from the risk account for Takaful. So they act more of like a fund manager in this case, in this model. Okay. Yeah, so this actually looks quite similar to insurance in the sense that premium, you go into your general fund or life fund, and then you use those money to pay for your claims and you got your surplus, but then the surplus goes to the operator in the case of insurance. Okay, so that's the Sudan model, quite straightforward everything. The next model we have is the Wakala model, which from the contribution from the participant, you already split this contribution into two. So the first portion of the contribution goes to the operator as a wakala fee, which is the agency fee that the operator is charging you for running or managing the fund and the Takaful business. Okay, and the remaining of the contribution goes into the common account, the risk account, which will be pooled with the other participants. Okay, and out of this fund will be paying the policy benefits. And again, for Wakala model, the total surplus goes back to the participant. So from the operator's perspective, you get Wakala fee, a fixed Wakala fee upfront from all the contribution that is written. Okay, and out of this Wakala fee, you pay out expenses in running the operation. So the upside for the operator would be coming from how efficient or how well they manage their expenses. So the lower the expenses they can keep, then the bigger the profit they will get from the difference between the Wakala fee that they receive and the actual expense outgo that they pay out. Okay, so this is the Wakala model, also a simple model. The next is a Mudarabah model, which is where the fee to the operator is through performance fee. So basically, you don't see any Wakala fee here. So from the contribution of the participant, you would put some into the risk account, which is the common account that is shared with other participants. And the other part of your contribution goes into your own personal investment account. Okay, so your investment account where you need to decide what you want to invest in and all that. So the profit that comes out of that investment, which is managed by the operator, they get a share of that profit. So their compensation is through shares of profits. So through the investment profit as well as through the underwriting profit, which comes from the other fund, being the balance of the fund and the claims payout. Okay, so this is the Mudarabah model. So you don't get a fee upfront. You get a fee depending on the performance of the funds that you manage. Okay, so from these income streams to the operator, then they will use those money to pay out the expenses incurred in the operation. So that's Mudarabah model. Okay, the next one would be Wakala model with a performance fee and Mudarabah on savings. So this is basically a hybrid between the Wakala and the Mudarabah. So we start with the participant's contribution. From here, you pay a Wakala fee to the operator, and you also have the investment account, your personal investment account, which will be dripped monthly into the common risk account. Okay, so this is a typical model adopted by family Takaful products with an investment account, which can either be a savings account or an investment link account. So we see that being commonly adopted here in Malaysia. Okay, so from here you see that the operator gets, the source of income to the operator would come from first the Wakala fee, and you also get a portion of the investment profit from managing the investment account of the participant. And you also get a performance fee from as a share of the surplus from the underwriting side of the business. And all these income to the operator will be used to pay out the expenses. Yeah, So so yeah, so like I mentioned before, this is a hybrid of the prior two models that I showed before. The next one would just be a Wakala model with performance fee, and this is more commonly adopted by general takaful operators in Malaysia, minus the savings investment bit, right, which is more for life basically. So so for this model, the contribution, again, you have the Wakala fee for the operator, but from the participants' risk account, which is the common account, the surplus will also be shared to the operator. But in this case, we don't differentiate. We don't tend to differentiate between the surplus coming from underwriting or coming from investment. For general takaful, it's usually just like a one-liner at the bottom of the account, the total surplus. So that's the surplus that's being based on to determine how much the operator gets. But in Malaysia, Bank Negara sets a limit to this percentage share of surplus to the operator, which is limited to 50%. So it cannot be more than what you give up to the participant. So Y cannot be more than 1 minus Y. Yeah. Okay, so that's pretty much all of the models that we tend to discuss today. And next we go briefly on the takaful market. First we touch on the global market. So when it comes to the global takaful market, there are various sources out there that we can source from. But notwithstanding that, we have quoted I think 2 sources in here just to give you a feel or a flavor as to where takaful is at the moment. So based on the 2018 IFSB stability report, it was reported that in 2016, the global takaful contributions stood at about 26 billion US dollars. Okay, and this covers all takaful, not just life, not just general, everything. Okay, and the average growth of between 2012 and 2016 is about 8.8% per annum. So this has been the development of the takaful contributions globally. In terms of the market composition by major domiciles for 2016, so we saw that the largest contribution came from Saudi Arabia and Iran, and Malaysia is actually the 3rd highest, although a distant 3rd lah, only 7%. Okay, and then that followed by Emirates and some Asian countries. So mainly Asia and Middle East. So Malaysia, we contribute largest to the ASEAN market, but then in Malaysia, 70% of our gross contributions is basically from family takaful, not general. So the remaining is general. And then as for Indonesia, it's worth highlighting here that the big population in Indonesia, they are also only big on family takaful. So general is still quite small over there. But the other markets, they are more focused on general takaful. Okay. Here we are just quoting another source, which is the improving the takaful sector in Islamic countries report by COMSEC. And in that report, you reported that our CAGR, our compound average growth rate of the global takaful between 2011 and 2017 to be at about 7% per annum. And the composition was suggested to be this between the composite companies, general takaful companies, life takaful, and re-takaful. And the global takaful assets in 2017 stood at about 46 billion US dollars. Okay. Okay, going to Malaysia. So here we are comparing, or we are showing the gross contribution for takaful in 2019, where the blue is in respect of general takaful, while the orange is family takaful. Okay, and from here, looking at from 2010 to 2019, the average growth, compound average growth of both is the same at 11%. Okay, but yeah, so in 2019, it increased by about 18% from 2018, as seen here. And I think, I guess the growth is also coming from, yeah, both motor, sorry, general and family. Okay. On general itself, just comparing Takaful to insurance in market Malaysia. So the top one is insurance, general insurance, while the bottom one is general Takaful. You can see how small Takaful is still compared to insurance. Okay, but growth-wise, we see that for general insurance, it's been tapering, rather plateau in the recent 4 years now. Whereas for Takaful, it's still growing. But of course, because the base is also very small, so yeah, we can see more apparent growth rates. Okay, but in terms of compound average growth rate for general Takaful, it was 11% per annum compared to insurance of only 4% in the last decade. As for life insurance and family Takaful, again, family Takaful is much smaller than the life insurance that we see, and with better, higher growth for the Takaful compared to the insurance. So the CAGR for insurance on the last 5 years is 5% per annum, whereas for family Takaful is about 12% per annum. Market composition for Malaysia in 2019. So we have 4 general Takaful operators in Malaysia as at 2019, and the biggest contributor would be Etika General Takaful Berhad, and this is followed by Syarikat Takaful and then Zurich, and lastly Takaful Ikhlas. Okay, there are only 4 players as of 2019, following the requirement to split the composite license. So some players exited, and I think just prior to that in 2018 there were about 8 general Takaful operators. So that came down to only 4 by 2019. For family, there are more colors to the market. There are about 11, I believe, players in the family Takaful sector, where the biggest player would be Prudential BSN, followed by Etika, and then Syarikat Takaful Malaysia Keluarga Berhad. Okay, just to give you a flavor on the market in Malaysia. Okay, an overview on the Takaful regulations in Malaysia. So shown here are just some key regulatory developments over the last decade. Of course, we had the Takaful Act enacted in, I think, December 1984. Okay, but this was subsequently replaced by the Islamic Financial Services Act 2013. So prior to that, we had other regulations that was released in Malaysia. So we've got the regulation on outsourcing, which outlines the minimum outsourcing requirements to be followed by financial institutions. And then you've got some framework for Sharia governance, which was crucial for Takaful operation, to set out the responsibilities and duties of the board, the Sharia committee, as well as the management. And then we had the TOF, or the Takaful Operational Framework, released in January 2012. And this, I think this TOF came about as Bank Negara recognized the potential conflicted objectives that exist in Takaful, where the principal to Takaful is basically the participants, okay, but at the same time, the shareholders who provide the capital, who are not the participants, would want to maximize their return. So by issuing this TOF, Bank Negara was, I guess, trying to ensure that the participants were protected, and at the same time encouraging innovation by the TAKAFUL operators. And this was subsequently revised and updated just recently in July, but effective July 2020. Okay, so it was to further clarify certain authorization of Sharia contracts and all that. We also had RBCT in 2014. So basically, the regulations for TAKAFUL in Malaysia tends to be a little bit lagged compared to the regulations for insurance. Insurance tend to come out first, and then the TAKAFUL will follow suit. So, for example, the RBCT, this was in 2014, whereas the RBC for insurance was like 5 years before, 2009. Yeah. Okay, and then we have the ICAP for TAKAFUL. This was basically the same as the ICAP for insurance, but of course with the additional section on Sharia governance or Sharia compliance. And we also had the phase liberalization. For this one is the same for TAKAFUL and insurance. Okay, what is this line? Did I just draw this? I think I did. I'm sorry. Okay, so the key distinct features between insurance and TAKAFUL. So for TAKAFUL, we saw in the models I presented earlier that we have separation of funds. So for insurance, everything goes into the general fund, and then that's where you pay out the claims, you pay for expenses, commission, and all that. But for TAKAFUL, we separate between the fund for the insurance, the TAKAFUL, the risk fund, and then a separate fund for the operator for the management of expenses and all that. So yeah, that's on the separation of funds. And then also in TAKAFUL, we have different share in various profits. So it depends on the contract that's agreed upon between the participants and the operator. So the share for investment profit, the underwriting profit, as well as the expense profit. Okay, the expense profit mainly goes to the operator. And then of course, the TAKAFUL is also governed by different sets of legislations and rules compared to insurance. So we specifically have the TOF that only is issued for TAKAFUL, and it specifies the requirements for the management for TAKAFUL operation. Okay. And okay, here is the more detailed comparison between TAKAFUL and insurance. Okay, I think these are pretty self-explanatory, but I would just, I guess, focus on this section here on uncertainty and gambling. Okay, so for uncertainty, okay, so for insurance, there is an element of uncertainty in the sense that the benefit that you get from the insurance as a policyholder is only contingent of the occurrence of the event that is covered, right? So if it's covered, you get. I mean, if it happens, you get. If it doesn't happen, then basically lost money lah. But how is this overcame in TAKAFUL is that because of the concept of donation that I mentioned before. So in TAKAFUL, the money that you pay to the premium, which is the contribution, is a contribution. It's a tabaruk. It's a donation that you make into the fund. So because of that, it becomes like a gratuitous contract rather than you expecting something which may or may not come. You know, so that's on the uncertainty portion of it. And in terms of gambling, the insurer would take speculative risk with its capital. So whether it makes a profit or a loss for the operator, it depends on the underwriting results. But again, for TAKAFUL, because of the concept of tabaruk, this makes the contract unilateral. Okay, so there's no element of gambling per se in there. And as I mentioned before, of course, the investments for insurance and TAKAFUL are different in the sense that TAKAFUL, your investments option is limited to Sharia compliant assets only. Okay, and you cannot be investing in interest-based assets or in gambling or brewery and all that. What else? Yeah, okay, I think that's okay for this slide. Okay, what about TAKAFUL versus mutual? Okay, so I mentioned before that TAKAFUL is essentially based on mutual cooperation between the members, between the participants. Thus, they two actually operate in a very similar model. But I guess the main difference under mutual is that for mutuals, members are responsible to make good of any deficits in their fund. Okay, Whereas in Takaful, the operator will instead provide an interest-free loan, which we call Kad Hasan, to temporarily cover the deficits in the risk account. Okay, so you don't recoup the losses from the participants. The operator will be providing this interest-free loan to cover for the deficits. And this loan, this Kad Hasan, will be repaid to the operator through future surpluses that arise from the risk fund, in the common account. Yeah. And the other difference for mutual is that the capital comes from members and the mutual through unallocated equity, whereas in Takaful, the operator provides the capital of the shareholders. Yeah. And then in the mutual setup, there would usually be member representatives in the board, whereas this is usually not the case for Takaful. And lastly, for Takaful, it is also possible to have multiple common accounts, multiple risk accounts with different classes or risk that is parked under each fund. Okay, and then on the other hand, for mutual insurer, we understand that this multiple fund approach is not common, apart from separating life from general or investment. Okay. Okay. Just to briefly go through the accounts for insurance versus Takaful. Okay, on the left is the insurance revenue account, and on the right is the Takaful revenue account. So as mentioned before, for Takaful, we would have two separate funds, okay, where the funds are for operator fund as well as a Takaful fund. So for the operator fund, the income would be the wakala fee under wakala model, okay, and then the income coming from the investment generated from the capital that's provided by the operator. And then the outgo for the operator's revenue account will be for the management expenses, for the commission, as well as for tax. And then alongside the operator fund, there will be the Takaful fund, where the income would be the contribution from the participants and the investment income generated from the technical reserves, which are held in the Takaful fund. Whereas the outgo would be the claims, as well as the wakala fee that you pay to the operator that goes in as income into the operator fund. So this separation is obviously not the case for insurance. Insurance, you have everything in one fund. So for the income, you have the premium, the investment on capital, investment on reserves, and then for the outgo, you've got the claims, expenses, commission, and tax. So you can see the stark difference in terms of accounting between insurance and Takaful here. As for the balance sheet, similarly, we still have that differentiation of the funds corresponding to the revenue account. You've got the operator's assets and the capital retained earnings for the operator, whereas for the general fund, the Takaful fund, you've got the Takaful assets and then the Takaful liabilities as liabilities. Whereas for insurance, you know, everything is together, one whole total assets and total liabilities. Okay. Oh, okay. So for Takaful, we've also got the card to meet shortfall. Should there be a deficit in the Takaful fund, but this does not affect your revenue account because it's basically just a movement of asset from the operator to the Takaful fund, basically. Okay. Okay. I mentioned before about the Kad Hasan, so just a little bit more on that. So because Takaful works on a risk sharing concept, so by right, any deficit incurred in the risk fund, the common account, by right belongs to the participants and not Takaful operator. But instead of recouping these losses from participants, Takaful operator would provide an interest-free loan known as Kad Hasan to the risk fund. Okay, but and this card will be repaid from future surplus of the risk fund. So when you have a deficit, okay, you get a card from your from the operator, and then going forward, when there's a surplus coming out from the risk fund, you have to use that to pay the card first before you want to start distributing or any surplus to the participants or the operator. Okay, so card must be fully repaid first before any surplus from the risk fund can be distributed. Okay, just to highlight that in the IFSA, Islamic Financial Services Act 2013, it did not say that Kad Hasan has to come from the operator. So it could instead come from Islamic Bank, for example. But in practice, we see that basically this would come usually from the operator fund. Okay, next is on the insurance model cash flows, where the intention is to show you the how it differs from Takaful. Okay, so using an example with 1,000 ringgit of earned premium for insurance. Okay, so from policyholder, you've got the earned premium that you pay to the operator company. Okay, so in the general fund, you've got 1,000 ringgit of earned premium. So out of this 1,000, you pay out commission. Okay, so we put here expected versus actual, just so that we can quantify the different components of surplus, like whether it's operating surplus or underwriting surplus. Okay, okay. So for example, like for management expenses, say you expect to pay 180, but your actual expense that you paid out is 160. So this is paid from the 1,000 ringgit, and then commission is usually the same, like you know exactly how much you're going to pay as commission. So that's basically actual equals to expected of 120, and then you've got the reinsurance premium. Okay, so from 1,000, because you expect to pay 100 as reinsurance premium, 120 as commission expense, and 180 as management expense. So that's 1, 2, 300, 400. So basically what you expect to pay for claims is about 600 ringgit. Whatever's left in the fund would be to pay for claims. So say the actual claim payout is 570. And then you also get reinsurance commission of 20 ringgit. And you also generate the investment income of 100. So let's see what is the insurance profit before tax of 24%. So underwriting, you've got 50 ringgit, which is 600 minus 570 is 30, but you also get commission income. So we just treat that as underwriting. And then you've got investment, which of 100. And then you've got operating of 20, which is the difference between this and the actual. So that's about 20 ringgit gap. So from here, you see that the insurance profit is about 170 before tax, and this became 129, 20% after tax of 24%. So this is insurance. So by showing you the next model, we see the impact of that cap on 50-50 sharing that is, I guess, imposed on Takaful in Malaysia, that is. So this is Takaful for Wakala model with 50% distributable surplus of performance fee. So same, earn contribution of 1,000. So you split this into operator fund and risk fund. So the operator fund is a Wakala fee of 30%. So that's because 180 plus 120, right? 300 for expenses and commission. So this is charged under Wakala fee. So that's 300. So what's left is 700 for the risk fund. For the risk fund, you pay out 100 as Ritakaful, and then you get 20 ringgit as commission income, same as insurance. I'm just yeah. And then you get investment income of 70, basically about 10%. And then your claims, again, you expected 600, but you pay out 570. So here, your surplus for underwriting is also 50. Okay, the gap between this and the commission income. Okay, and your investment is 70. So the total surplus is 120 before tax. Okay. Now what happens to operator fund? Operator fund, you got 30 as income, and then you pay out 160 as expense, and you pay 120 as commission, just like before, with a 30 ringgit investment income. So for this operator, from the operator fund itself, your operating profit is 20, which is the gap between these. And then your investment is 30. And you also get a share, 50% share of the surplus from the risk fund. But this is capped at 50%. So for 50% of 50 becomes 25. And 50% of 75 becomes 35. I'm taking the before tax to avoid double counting of taxation here. So you've got 50 from the operator fund profit, and you've got another 60 from the surplus of general takaful fund. So here your total profit before tax is 110. Yes, 110 compared to 170 under the insurance model. So, and because of that, after tax, from 129 we saw before became 83 ringgit. So this is basically because of the money loss, I guess, not really lah, but yeah, the only 50% share that you get to take from the underwriting portion of the takaful fund. I hope that's clear. Okay. Okay, so so that's all for me. I pass you back to Shura.
Let me make sure that the screen is centered. Okay. All right. Okay, we have about maybe 10 to 15 minutes to go because we want to allow some Q&A session. So I'll be going through the next slide in maybe a bit faster compared to Emma. So the next two section talks in particular with respect to the investor perspective for takaful. So we're going to start first by talking about the challenges and opportunities as a business investment. So as an investment, obviously from investor perspective, you would like to know how are you going to make money. I mean, face it, if you're going into this as an investor, you need to be able to pay off your shareholders, you know, their investment returns or their return on equity or ROI. So in respect to the takaful model itself, you know, we saw that the wakalah fee with performance fee has been widely used in you know, in ASEAN. If you go to the Middle East, it's more on, you know, pure wakalah fee model. And you know, in this particular slide, we're looking at the three main revenue stream from a takaful operator perspective. So first of all is, I hope you can see the my cursor moving. So first of all, in terms of the surplus sharing or performance fee. So in jurisdiction where this is allowed, the takaful operator or / shareholders can take a percentage of the underwriting profit that arises from the risk fund. And this proportion or has to be agreed upfront. So when you sign off on the proposal form, the participant, when they sign off on that, there would be a mention in terms of how much of that underwriting surplus or any surplus arising in the risk fund is to be shared between the participant and takaful operator. So that is pre-agreed percentage upfront. In certain regulation, like in Malaysia, for example, Bank Negara put a limits in terms of how much that can be shared. So the maximum that can be shared is 50% for Malaysia. But if you go to Indonesia, for example, you know, you will see that the surplus share is, you know, even up to 80-90%. So 80-90% of the underwriting surplus is to the takaful operator. And of course, as I mentioned, in the Middle East, where you know, you can't share the surplus, there's no surplus sharing or performance fee elements. So it's just a pure wakalah fee, so there's no sharing. So this wouldn't be that additional stream of income. Looking on the right hand side, the second item, which is the wakalah fee. So this is also has to pre-agreed upfront. It will be stated in your akad in terms of how much of the wakalah fee will be taken by the takaful operator. And the plus side of this particular model is that it will minimize the expense overrun of the TAKAFUL operator, because you are taking the fee upfront. In certain jurisdiction, you are allowed to load up your wakalah fee for a reasonable loading for profit. So for example, your wakalah fee is a combination of your commission expenses, management expenses, and profit. So management expenses could be 15%, the commission could be another 10%. So that's 25% already. And you may load up, you know, a small profit for 5%. So that make up 30% of wakalah fee. Bear in mind, obviously, the purpose of the wakalah fee is to cover for the expenses of the TAKAFUL operator in running the business, as well as in paying the agents or slash brokers. And how would the TAKAFUL operator makes money from the wakalah fee? Obviously, if they are able to manage their expense outgo efficiently, any gaps between what you receive from your wakalah fee and what you paid out for your expenses would be for the TAKAFUL operator to keep. So that would be, you know, their profit in managing the expenses for the TAKAFUL operator. The third component is investment income. So in most jurisdictions, the capital, the paid up capital that you have to put in setting up the TAKAFUL operation comes from the shareholders. So that money is the shareholders pumping it into the company to ensure that there is enough capital to support the business. So for example, in Malaysia, we have a risk-based capital requirement. So you would need a certain level of capital to support the business. Any investment income from that capital is to the operator. So you keep that investment income. But there is also investment income that is coming from the risk fund. So normally this is being shared. I mean, you can share it with the TAKAFUL operator. As Emma have shown earlier, that there is quite a number of model. You know, you could have a mudarabah share of the investment income with the TAKAFUL operator, or it can also be treated like performance fee. So, you know, when you do, when for example, in a general TAKAFUL operation, we don't differentiate the underwriting profit and investment return of that risk fund. So it's taken as one. So that can be shared, you know, following the 50-50, you know, sharing policy of the company. So these are the three main stream of income. Moving into Malaysia, we have specific capital requirement as far as, you know, the minimum paid up capital is 100 million for both insurance and TAKAFUL. Both are subject to the risk-based capital regime. And, you know, under the IFRS reporting at the moment, both are based on IFRS 4. Moving on to IFRS 17, there are a numbers of, I guess, discussions or debates that are still ongoing. So that will be covered in more detail in the next webinars. I won't cover that here. The last point, the consolidation. So in cases whereby TAKAFUL operation is owned by a multinational, we do notice that how the MNCs consolidate the reporting of TAKAFUL entity in Malaysia in their overall financial statement, they seem to treat it like a conventional insurance subsidiary. So basically they treat the TAKAFUL operator or the shareholders fund and participant fund as one. Emma talked earlier about Kak Hassan, so I won't go through that, but this is there for you to go through. So next point, I'd like to talk about the challenges in TAKAFUL as a business investment, because these are quite, I mean, some may consider it as an obstacle to invest into the business. But you know, so we have 2 slides on this. So the first point here is talking about, you know, the market perception on TAKAFUL being the same as insurance, you know, except for the halal part, you know, the permissible part, and that possibility of surplus refund. So with that perception, it resulted in a direct competition with insurance. And this is not really good for an industry or market that is that is very young compared to insurance, which has been there for more than 100 years. Takaful is barely like 40 years old. So there is a need to differentiate Takaful from insurance, especially in terms of the market positioning of it, because you do not want to go head on to do a price competition with insurance. I don't think that should be the way to go for Takaful. And there is also the second point there. Takaful has also been confused as as a social insurance, and because of that, there is that expectation that it should be cheaper than insurance. When technically speaking, again, because we're actually technically speaking, when we do pricing, the fact that you can have a return of the excess, the excess surplus through that, surplus refund, as an actuary, we're probably gonna price it, to be somewhat higher, because if there's any leftovers, it can be returned back. So, so this misconception of Takaful being cheaper than insurance is quite a hurdle out there. Third point, if we talk about regulation wise, so Emma gone through to differentiate insurance versus Takaful, and you can see that Takaful is on a risk sharing basis versus insurance, which is risk transfer. So the responsibility of the insurance providers is much higher, because they are taking on the risk, whereas Takaful is a risk pooling between the participants. But unfortunately, certain jurisdiction does not differentiate that risk profile. So the same regulation are being applied to both. Another example is, the Sharia compliant investment tool of a Takaful operator. So for example, take Sukuk, for example. So that's asset based compared to corporate bonds. So one may argue that perhaps Sukuk should attract a lower risk charges compared to corporate bonds, but that's not the case in some jurisdiction out there. There is also limited Takaful capacity. So you will see that because of that risk sharing principle of Takaful, homogeneous risk, which mainly concentrated on personal lines. So that's why you will see motor is a widely used class of business for Takaful, because they once you have a homogeneous risk, it's quite easy to do that risk sharing kind of principle. And in the case of Takaful capacity, if you talk about the large and specialized risks, there is not much homogeneous risk even at the upper level of the Takaful market to actually spread this risk around. So this is there in terms of that obstacle. The restriction on investment. So unlike in Malaysia, I think we're quite fortunate, because our Islamic finance is growing significantly over the years. We probably have, I believe we have even a higher securities compared to conventional securities as far as Islamic finance is concerned. So in Malaysia, we're lucky. We have quite an ample supply of Sharia compliant asset, but there could be another jurisdiction out there whereby, they have very limited Sharia compliant assets to invest into. So that's unfortunate. That's quite unfortunate. So it doesn't give them this spread in terms of their asset risk. Limited talent and resources. Again, because this is such a young market, that we only have quite a handful of those very experienced, practitioner out there as far as Takaful is concerned. Item 2 and 3, I want to talk about this together. So given the requirement to, surplus with performance, wakalah fee with performance fee model, you will need to refund back those surpluses. So you want to make sure that you have a system that's capable to do that. And that, unfortunately will contribute to higher operating expenses to the TAKAFUL company. So on top of the system, we also have this requirement for a Sharia department and a Sharia board within the company. So these are additional function that is required in TAKAFUL versus insurance. So that could contribute to a higher operating expenses. There is uncertainties faced by the TAKAFUL on the IFRS 17 reporting, so I'll leave that to be covered by the next webinars. The last point there, so with the risk sharing concept in TAKAFUL, it's not unreasonable to expect that the ROE in a TAKAFUL operation can be lower than insurance. But unfortunately, this may not necessarily be acceptable from an investor perspective, especially if you have a holding group that hold or that have stakes in both conventional insurance and TAKAFUL company. So I guess from an investor perspective, they may need to weigh quite a number of these factors. And they probably need to ask themselves, like, if they don't have the TAKAFUL entity, would they be able to reach that market using that existing conventional company? That may not be necessarily possible because, for example, there are certain markets out there that prefer to have it being provided by a TAKAFUL entity. So you may want to look at it from the perspective that, despite the lower ROE or the potentially lower ROE that you would get from TAKAFUL operation, it does provide an opportunity for that holding group to venture into a market that they are not able to go into because of that, conventional versus TAKAFUL principle. So we start with the con first, which is the challenges, and then let's move to the brighter side of TAKAFUL. Let's talk about the opportunities of it. So if you look into Malaysia, the penetration rate for TAKAFUL is still quite low. We also have this rise of the young and affluent Muslim population in the country. So not just in Malaysia. I mean, if you look at Indonesia also, for example, this particular segment, I guess they are the growing market in there. In Malaysia, in particular, for that third segment, there's this government commitment to increase the share of the Islamic finance in the country because the aspiration to make Malaysia as an Islamic financial hub. And that meant that the loans, talking about housing loans, car loans, are mainly provided under the Islamic finance, and these loans required it to be protected by TAKAFUL because it needs to be Sharia compliant. So there is, if you look at the stats in terms of the growth in Islamic finance, it's tremendous, it's double digits, which implies that there are opportunities for the protection cover of those loans, of those properties, to be covered by TAKAFUL. Increasing demand for TAKAFUL. So we saw that, with the affluent market, they want to have TAKAFUL. They demand it to be, TAKAFUL protected. And the third point, despite TAKAFUL to be quite relatively young, there is, we can still learn from our conventional insurance in terms of the product development, product innovation out there. But, we can adapt this to make it more, TAKAFUL spirit. And interestingly, so this last point, we saw this happening in Indonesia actually. Our distribution channel for TAKAFUL does not need to be the normal conventional agents, brokers, and whatnot. We saw that in Indonesia, the imams, which is the Muslim clergy, and the religious leaders, they do promote on the importance of TAKAFUL products. So sometimes this can be done during the Friday prayer, of course, given the COVID-19 situation at the moment. But, it's something that has been done and it can continue on to be expanded because, the idea of TAKAFUL is that risk sharing. So you are helping your brothers and sisters within that particular pool of takaful, especially when they in needs of, especially when they are in adverse situation where you could help them through this particular tool. So key consideration as an investor in takaful, in fact, I think in any investment, you need to know and understand the drivers of the market as well as its regulatory environment. Differentiation is key to success in any market, in fact. And in takaful in particular, I think it's quite important to properly do or strategize the market positioning of takaful so that it doesn't result in cannibalization of your sister conventional insurer and whatnot. You need to understand what best fit the company's strategy as far as in choosing your takaful model out there. And of course, you need to be able to source suitable key personnel with the appropriate or relevant takaful background in order to move the company forward. And we talked about the ROE earlier. So from an investors, you would need to reassess the appropriate expected ROE for takaful based on your perceptions of the risk that takaful carries. So if the expected risk is lower, so it's not unreasonable to assume that the ROE can also be lower. So the last section here, we'll talk about, the actual roles in takaful. Surprisingly, given the infancy of takaful, we saw quite a number of actuaries out there, holding various roles in the company. So it's not just restricted to valuation or pricing. We've seen, actual people do risk management, for example, or even some going to strategic. So I think because of the quantitative technical skills and inputs that an actuary possess, they could contribute quite significantly in the other non-actuarial departments. So this could be in finance, risk management, asset liability, even in takaful and underwriting, and of course in strategic planning as well as claims management. And I think that goes to the fact that you have a sound understanding of the working model of the business. You understand how the cash flow works. You understand the risk. So it's provide an opportunity for an actual people to play a more active role in a takaful operations. We saw some in the smaller takaful company whereby an actuary is juggling across various roles. But of course, this would also unfortunately contribute to a potential conflict of risk. So that's just something to bear in mind. So with that, we finish up with the slides. I think we can go to the question.
Okay, thank you, Shahada. Thank you, Emma. I think we've gone through a whirlwind of what takaful looks like. And you've gone through very technical elements of what model looks like. And, the last part was very interesting for the investor. You've shared some practical experience there. So there's lots of questions on Slido. Generally, they're asking about the card concept. I'll take those. Some text and other clarification that's needed. But one of the easier questions, I think, for you to answer first is, the first question was, what's a typical model? I think this is Emma's slide. What is a typical model used in general takaful in Malaysia? And are they profitable? And I assume because it's quite hard to be making profit for general insurance, so they're asking whether general takaful would be profitable.
Okay. It would be the wakalah fee with performance fee model that is being used by the 4 general takaful operator in Malaysia. It's gone through quite a number of evolution. So when Syarikat Takaful Malaysia came about in the 1980s, we started with Mudarabah model, But then over the years, even STMB have moved to the wakalah with performance fee. We also used to have, Hong Leong MSIG Takaful, which started with pure wakalah model, and they actually moved to wakalah with performance fee. So it seems that everyone is diverging into that asset today. Yes, they are making money. You can look at the financial statements of the companies. I guess the plus side of the 4 general takaful operators that remain today is that they have been around for more than 10 years. So if you look at their financial statement, you will see that even the risk fund, it has its own retained surplus. That's main surplus that are not distributed to either the participant or the takaful operator that remain in the risk fund, to continue to support the business. Some of these companies, the retained surplus is in, more than 100 million, because again, they've been there for quite a while. They are profitable, although given the fact that these general takaful players are mainly motor player, and given the liberalization that has occurred, in the last few years, we do see that the profit are shrinking because of the fact that the price are more competitive. But they are making money. None of the 4s have any outstanding cards in their books.
Okay, you brought up card. So question that comes up about the card. The interesting one is that would a prospective participant know that there is a card at the point of sale? Does Bank Negara require this to be disclosed? And if so, where can she find it? He or she find it in the
yeah, it has to be disclosed in each company financial statement. So if you look
can I stop you there? Can I stop you there, Shi? So this is current reporting standards, right? The IFRS 4.
Yes, current.
So we don't know what 17 might look like. Yeah.
We'll leave that to the next webinar. But yeah, at the current reporting standard, you can see. So there will be in the financial statement of this company, the takaful operator will recorded Kad Hasan receivable. Yes, Kad Hasan receivable, and then the corresponding risk fund will have a Kad Hasan payable. So those information would be in the balance sheet of the company, and the notes that follows it, the financial notes that follow it would have a more detailed information on Kad Hasan. Yeah.
Okay, I'm going to go to the third question on card. If the card for the previous years was not fully, sorry Sylvia, the next question. If the card for the previous years was not fully paid, can takaful contribution be increased for the purpose of repaying card?
Okay, so there's 2 questions here. So you're talking about, I mean, I can see that there's 2 elements here. So first is, the fact that you have an outstanding card that's not yet being fully paid by the risk fund to the takaful operator. So that's one. And the second one is actually on pricing. When we talk about increasing contribution, that's on pricing. So the beauty of general takaful is that the policy is yearly renewable. And pricing, given the liberalization, company can decide on their pricing. So yes, technically you can increase your contribution so that you have more surplus to be able to repay the card. But you have to bear in mind in terms of price competition. Are you able to charge that much and still retain or attract policyholders to buy your product? So I think, so it's not really as simple of increasing and hoping people will, pay the higher premium. You also have that competition aspect of it to bear in mind.
Yeah, and I think from practical experience, when we're acting as a pricing actuary, we've not actually put the margin in to repay card, right?
No, normally we don't. We don't put that in. because otherwise you'll be charging, you know, so much higher than your competitor. So you're going to lose your existing
And from
business.
that
You won't be able
governance
to
perspective
attract
as
new
well.
policyholders. Yeah,
Okay.
it's a
Next
quite
question.
competitive market for the general takaful actually.
I can imagine. Yes. So next question is: given Card Hassan exists, shouldn't that is one of the element of risk transfer, especially when the card is not fully repaid? So this is the core question for Takaful, I believe. Is there a risk transfer or not? Because, you know, what happens when the card is not fully repaid?
I mean, it's the term, okay. There are a number of, I guess, views on this one. So if you go to the extreme that, okay, if Card Hassan is not fully repaid and it resulted in a write-off, so that's mean, you know, the risk fund is not paying the takaful operator at all. So some view that as, you know, risk transfer. But, you know, in reality, in Malaysia especially, all the Card Hassan has been fully repaid. So it is still working as a, you know, as a loan mechanism, you know, you're an interest-free loan. It has been repaid.
Yeah, I think there's a lot of resistance to write off the card. You know, they bring the card perpetually going forward if there is a card, but there is a lot of resistance to actually write off that card. There's tax issues as well. Yeah. Zainal was sharing in the WhatsApp that there are takaful operations in Bahrain with perpetual card. So
Perpetual,
those,
right?
still not written off, but you know, it's still there.
Yeah. I mean, in Islam, if you have a loan, you borrow money from someone, you are required to repay it regardless. So even if you die, your next of kin is responsible to take on that loan. So we don't really, I mean, Islamic wise, we don't really have the concept of write-off. So write-off is more because of regulation requirement. You know,
yeah, I recall you were saying that deficits are more, I mean, as an operator, you only have this card to fund a deficit, but if you have mismanagement, then it's not to cover a deficit.
Yeah, so that's more like
charge,
if you were to act negligently, you know, in managing the risk fund. So that's I guess like a punishment because you know, you are given a responsibility. So when the participants sign off on the akad, you know, they pre-agreed on each other roles and responsibility. And you know, the roles of the takaful operator is to manage the fund. So if you mismanage it, you know, I think that's right.
That shouldn't be covered by card.
Yeah, but that write-off shouldn't be construed as transfer of risk.
Yeah,
because it's because of the fact that you mismanage. It's not really because of transfer of risk.
Yeah. Still on card, in the way Card Hassan is given to takaful by the operator, can takaful company give interest-free loan to the operator when operator needs money? I think, this one is a bit funny because takaful company and operator is actually the same entity. Perhaps I think the question is more if can the risk fund give a card to the operator? Can it be the other way around?
Yeah. I think it's the risk fund and takaful fund, right?
I think so. Yeah. So can the takaful fund give a card to the operator if they need money?
I believe this was raised or this was addressed in the draft, the exposure draft of the latest TOF. Has the TOF been finalized? Is it effective? Do you remember, Izzah, has the new TOF been effective or is it draft? Is it exposure draft?
It's 2019. I think it's effective.
Okay.
I know it's my area, but yeah.
Yeah, I mean, if we're not mistaken, there is an allowance for that. So they introduced it as, you know, one of the contract that you can subscribe to. That is allowed under the latest TOF requirement. I'm not familiar with the detail, but I think later when Izzah cover the regulation, she can shed more lights on this later.
Okay. Next question is on tax. Is there a discrepancy between between conventional versus takaful, and who pays more tax for the same level of profit?
Okay, I think for general, it's quite straightforward. 24% corporate tax apply to the risk fund. 24% corporate tax also applies to the shareholders fund. So this 24% is actually similar to what is being applied.
Is that 24% on profits? Is it 20%
on profit? On profit.
Okay, on profits. Yeah.
So that's for general. So that is the same for the conventional general insurance. But if I'm not mistaken, for family takaful, there is still some discussion on it. I believe MTA, our Malaysian Takaful Association, is trying to lobby our internal revenue on some of the calculation interest, which I'm not quite familiar with it. You remember, Aiza?
It depends on interpretation, but I do know that they're still lobbying for some clarification on how wakala fee is defined. And at the moment, it's not a level playing field for the family operator. They're still lobbying LHDN to get to the same level of tax.
Remember, for the family, there's still issues on it. Yeah,
there's still issues on it. Yeah. Okay. Next question. Still on card. Does Card Hasan exist mainly because of the guaranteed sum assured, hence the risk transfer exists? If a mutual fund is adopted, that is pure risk sharing.
Okay.
I don't know how to interpret this question.
Yeah. I mean, okay. I'll go back to what our Takaful operational framework says about Card Hasan. So Card Hasan arises when your total liabilities is more than your total assets. So that's how the framework define it. So if that arises, the Takaful operator is required to make good of that deficit by Card Hasan. So it has nothing to do with the benefits that you covered or whatnot. And I think we talked about the risk transfer issues earlier on card, so I won't go into that. But you're right, mutual fund, if mutual fund is adopted to its very pure or core principle, that is pure risk sharing. But Takaful, because of the regulation, and there's also the need to make it parallel with insurance, some may argue that this really looks like insurance in its cost, but you have to take cognizance that each country have their own regulation in terms of regulating it. So that shouldn't be misconstrued as signifying that Takaful is a risk transfer, I guess. Yeah.
Okay. Moving on to the next question. Compared to conventional business, Takaful business tend to be less profitable. I see where this is going. Can I have your views on the shareholders' perspective on this?
Oh, okay.
This is all your feasibility studies that you've been doing.
Yes, exactly. Okay. If you were looking on the notion that, oh, I can only share 50% of that surplus, compared to insurance whereby I get to keep 100% of it. So yes, it does seem that Takaful is less profitable. But if you take a look at the combined ratio of the general insurance industry versus general Takaful industry, especially in the last 5 years, interestingly, general Takaful industry is performing better. So why is that the case? So I think it also goes back to the risk profile that you attract. In particular, you will notice that for motor insurance versus motor takaful, so this is like a commodity kind of product, right? It's pretty much governed by the act. What you must provide it in terms of the product. So there's not much product differentiation between motor insurance and motor takaful, but motor takaful in terms of its experience is actually performing better. So despite the liberalization, we do see that it is still performing better, and it's probably because of the risk profile itself. As you know, that motor in terms of fraud cases is quite high for motor. And although there's no study to confirm this, it'd be interesting if someone would come up with a study to look into it. You know, perhaps with the fact that you are subscribing to Takaful with a certain intention in mind, you wouldn't be doing fraud on your motor Takaful versus motor insurance. I don't know, but this is quite interesting because if you look, I mean, as I said, if you look on the theoretical of it, yeah, you would thought that, hey, you're not making a lot of money on Takaful, but if you look at the financial of it, you'll be surprised that these Takaful players are actually enjoying quite a good sum of profits, despite, you know, compared to the conventional peers. So yeah.
So technically, the same portfolio, the same underwriting performance, yes, Takaful would be less profitable. But what you're saying is there are niche market out there that Takaful can exploit.
Yes.
That seems to be giving better loss ratios.
Yeah, I mean, yeah, these are all in the financial statements of those companies if you look into them. So
that's interesting. Okay.
It's interesting actually. Yeah.
Yeah, it's interesting. I'm not sure how that applies to on the family side, but it'd be quite interesting to check the medical portfolios if that's better as well.
Yep.
Yeah. Next question, is card equals to card Hassan equals to card for PRF savings? Yeah, we got tripped on this one, remember, on the top? So card is a loan, card Hassan is a benevolent loan, which is from operator to the risk fund. When the TOF framework talks about card for PIF savings, it's actually a different contract. Yes, it's not the loan, right? Yeah.
No. It was
I think so. This is
so card equals card Hassan, yes, but it's not equal to card for PIF saving, not based on the latest TOF.
Yeah, the latest TOF makes reference to card for PIF savings, but it's not the same. It's not that card. This is a different contract. And I think it's just the capital guarantee that comes in the PIF savings, like a bank deposit.
Yep.
Okay. Next, why Sukuk should attract lower risk charges than corporate bonds? Asset-based, right?
Yeah, Sukuk is asset-based. Corporate bond is not. So
yeah. So that's one way to look at it. Is M&A for Takaful active?
Are you talking about Malaysia? I think if Malaysia at the moment, because with the IFRS 17 that is going on, there's a lot of uncertainty. So but again, there are a lot of M&As that's not being disclosed, you know.
Yeah. We've done a lot of M&As in the past.
Yeah.
I know we have, but I think that's tapered down. There's only 4 general Takaful players at the moment.
Yes.
Yeah. So for life as well, it's 11, and they're mostly owned by the MNCs. So the smaller ones, perhaps, are still reconsidering because of the paid up capital. But elsewhere, yes, Indonesia seems to be quite active for Takaful.
Yeah. I think there's a lot of potential there.
Mm-hmm. Yeah. Next question: is there a big re-Takaful market?
It's not. I mean, if you compare it to the conventional, it's quite small. In fact, you know, we have cases whereby, especially for that large specialized risk, because you can't get the capacity from the re-Takaful market, so they have had to actually source it from the reinsurance market. So so no.
Those specialized market would be harder. On the family side, on the family side as well, all the traditional big reinsurance players are also in the re-Takaful space. Swiss Re, Hanover Re, so they're Munich Re, they're in that space already. But yeah, I think the issue might be more for the general Takaful. It's there, right? Except that for that specialized risk.
Yeah.
Okay. Next question. If payment is benevolent contribution, that's donation, right? Then how do we tie risk transfer from member to the Takaful fund to the payment made? Is he asking about the contract, do you think?
Then how do we tie risk transfer? I mean, it goes into, you donate to a pool, and this pool, which is the Takaful fund, have a certain roles in terms of paying the the claims to the members of the pool. So how do we tie the risk transfer for member?
More regulatory driven, right? Yeah. There are like legal contracts in place.
Yes, and it's risk sharing also. I mean, we're not using the term risk transfer. It's risk sharing for the members, from the member to the other members within the pool.
Yeah. Okay, Frank Ash has 2 questions for us. I understand he works in the risk management space. So his question is there a good paper on a full analysis of the whole set of risks, especially operational, of a TAKAFUL operation, both systemic and company? And then the next question from him as well is, from the description today, there seems to be potentially large areas of risk that haven't been analyzed fully. What do you think?
I mean, TAKAFUL is just like a conventional operation. So whatever the risks in conventional are pretty much transferable or applicable to TAKAFUL. Yeah. But I guess they would be a lot more because we have this Sharia requirement, Sharia compliant requirement. So that would implies, or that would mean that there is the Sharia risk that is inherent in TAKAFUL but not in conventional. But if you talk about, you know, the TAKAFUL/insurance risk itself, it's still there. The operational, the market, assets, credit risk, it's still applicable to both entities. So yeah, yes, Sharia. It is quite a big thing. In fact, in Malaysia, we have one particular guideline just talk about Sharia compliance and the requirement of it, because it is one of the branch of the risk management of the company. So aside from the typical, you know, the insurance risk that you would have assumed a TAKAFUL entity would have, the Sharia compliance is also there.
Let me just add to that. So on if you're asking for a white paper on industry level for full analysis, we're not aware of one that's comprehensive. But from the company's perspective, they have a risk management framework. They have an internal capital assessment, like an ORSA, that looks at the risk from the company perspective. And even the Sharia compliance, they're subject to a Sharia audit, a review of the Sharia audit. I'm not sure how often they do it, but they do have an audit on the Sharia compliance as well. So that's very well governed in Malaysia. But if that's been put together on a paper for industry, I've not seen it. Yeah. Last question. Oh, hold on. Sylvia, it's the very last one. Can we apply the same treatment of IFRS 17 for both TAKAFUL and conventional?
Stay tuned to the next for that answer.
Okay. I hope the question's still coming in. Can TAKAFUL compete against insurance? Because insurance tend to be more attractive to customers financially, or should they even be compared?
I'd like to take an example from this study that we did in Tanzania. So we did a TAKAFUL feasibility studies, and we actually helped the regulator to come up with the TAKAFUL regulation there. So when we were there, we were there for two weeks, so we met a lot of people. What we discovered was that in Tanzania, the business, the commercial aspects there are held by the Muslim. And these Muslim, they want to have a TAKAFUL cover. They demand for it. So in fact, you know, we met one of the business owner. He didn't even bother to buy insurance protection for his business. And we asked why is that the case? And he straight out said, don't you know insurance is haram, you know? So I think it depends on the market. So I guess that's why it's very important for you to know and understand the market that you want to go in. What is the value proposition of TAKAFUL to your consumer? And as I mentioned, going in straight on with price competition is not going to work. You have to find your niche, and you have to do your market positioning in order to make the Takaful a success in that particular market.
Yeah.
So
I'm not quite sure we agree that insurance products tend to be more attractive to customers financially.
no,
I mean,
now I think the price competition is there, but in my example for the Tanzania, they don't mind.
You don't care about price, right? Yeah.
We ask them, okay, if there is a Takaful product in Tanzania that is 50% more expensive than conventional, would you still buy it? They say, yeah, definitely, because insurance is haram. So I think it depends on your customer.
Yeah, exactly. Yeah. Okay, let's not dwell into that too much.
Yes.
Should Malaysia's slightly different. Should 50-50 sharing of Tabarut surplus be allowed? Sometimes I question if that's ethical, especially when the TOs claim that Tabarut belongs to participants. Yeah, the Tabarut.
Yeah, I mean, that's why we term it as a performance fee. It's an incentive to the Takaful operator to not mismanage the fund, to ensure that the fund are in surplus, because once there is a surplus, they can get a piece of it. So it's like it's a performance fee. So that's
It's
how
a performance. It's an incentive fee.
It's an incentive for you to manage the fund efficiently. Because we do not want a Takaful operator. I mean the case in the Bahrain, like they have perpetual perpetual card. Like that's not good for the risk fund.
I mean, I don't know much about what happened in Bahrain, but I suspect that the Tabarut that they collected, that the price was too low. So that's one of the reasons why.
That contribute to perpetual card, right? Because you never have enough surplus.
Yeah, but it's not because they estimate it wrongly. I think it's underpriced, and that's why I guess this 50-50 sharing, even though it seems a bit funky, but it's an incentive to manage that Tabarut fund correctly. We've talked about the second question. The third question, would Takaful operator get a share of the Takaful surplus?
The Takaful, it depends on the Takaful operator. They may have their own surplus distribution policy, and that would go, but whatever surplus that your Takaful operator distributed would go to the risk fund.
Yes, not the
operator, not to the shareholders, because what is being what is being Takaful is the risk fund, not the shareholders fund. So I think that's quite important to highlight here. Under the Takaful operational framework, they have quite a number of requirements for the Takaful surplus distribution, whereby it has to be determined based on the Takaful pool of risk, not on each cedent risk. So unlike conventional insurance, whereby the profit commission is based on the cedent risk, for Takaful, it has to be based on that pool of the Takaful fund. So that's quite a big difference between
a big difference, right? I understand. Okay.
I think we're off. Yeah, we're quite. Yeah, it's 12.
Yeah, I know.
So thank you very much, everyone.
Thank you so much, Emma. Thank you so much, Shuhada. It's been interesting, and there's lots of still questions coming in, but I think we do need to wrap up. Thank you so much. The next webinar is on Wednesday, followed by a Friday one, and I encourage you to have a look at what's coming up. And if you find this interesting, please stay tuned. 17 questions are being answered on Friday and next week. I think don't miss next week if that's something you're particularly interested in 17 being applied to Takaful. Thank you, Emma. Thank you, Shuhada.
Okay.
Bye.
Thanks, everyone.